Welcome, everybody, to the Antelope Valley Chambers of Commerce Chamber Talk, our podcast that we try to do on a fairly consistent basis here. My name is Mark Hemsreed. I'm the CEO for the Antelope Valley Chambers of Commerce. Of course, the Antelope Valley Chambers of Commerce has just is a newly formed entity from merge of the Palmdale and the Lancaster Chambers of Commerce. So we're sitting here in the beautiful Antelope Valley. Today was a brisk 65 degrees out there and warm and sunny. Beautiful day up here in the high desert, as we call it. And today we're going to be talking about something that I think a lot of businesses just aren't aware of, and that's some new legislation, and it's primarily just called Cal Savers. My guest with me today is Pankaj Dayal, and he has his own financial services business here in the Antelope Valley. So, Pankaj, we're going to talk about three main things here. I know we're going to talk about plan design, the implementation, the service providers, how you select a service provider, and then ongoing maintenance of your retirement plan for your employee. But you niched right into this retirement planning, and you just didn't do it because of Cal Savers. You were doing this, prior to Cal Savers, that new legislation that went into act last year, I think. What got you into this niche? I mean, tell me a little bit about yourself and how you got into this thing.
Well, thank you, Mark. Thanks for the warm introduction. And yes, I've been in this business for about 19 years now. And I've been in California, in Palmdale, for just under 5, actually over 5. And I started in this business coming from the city of New York, where we have a pension. A pension is a defined benefit plan, but it's called a pension because all you have to do is meet the number of years of service and the age. And as long as you meet that criteria, you collect a pension. From there, I started in the investment business, and I decided that since I really like the investment business, I want to be in it long term. How can I differentiate? So I decided to specialize in one area, which is retirement plans. So a defined benefit, defined contribution, and coming to Cal Savers, which is only about a year old now, and it went into effect June 30th. Of 2020. So if you have 100 or more employees and you do not offer a retirement plan for your employees, you are mandated to enroll them into Cal Savers. Come June 30th of 2021, it'll be down to 50. And June 30th of 2022, it'll be down to 5. So if you are a business in California and have at least 5 or more employees, you have a choice to make whether you have your own retirement plan or you just enroll your employees in the Cal Savers program, which is nothing but a payroll deduction Roth IRA.
Excellent. So when we say that, like right now, it's large employers, ones that have 100 employees or more. Is this full-time equivalent or is this just total employees?
They are saying it's total employee count, so it could be full-time or part-time, but you can enroll them. There is no cost to you as the employer. The only obligation you have is either you offer a plan or you enroll your employees in Cal Savers.
Right, and then Cal Savers is actually a government-run program. So you have a department. In the state of California, will have a department for Cal Savers, and they'll have an administrator, and they'll have staff and all that stuff, and they'll actually take the deductions from payroll from the company's employees, and then they'll manage those funds for them. Is that correct?
I'm not an expert on Cal Savers, but I will say this, that it is, from what I understand, if you go on the Cal Savers website, there is a company called Census that does the record keeping and the administration. So they're the company that runs the plan behind the scenes. And when you, as the owner of the business, enroll your employee into the plan, you are done. Your obligation is fulfilled. So at that point, the employee, if they have a question or they need help, they would then call either an 800 number or go on the website or whatever the situation is. And from what I understand, it would be someone at a census that would be handling all the calls.
Okay. And the alternative. So you live in the alternative universe there. So you can either go to the state, go to CalSavers, or if you want a direct contact and a personal relationship with someone that's going to help your employees, they would call someone like you, a financial planner or someone that does retirement funds.
Absolutely.
So let's talk about some of the benefits that someone like you can provide.
One of the biggest benefits, being independent and being a fee-only advisor, the biggest benefit I can offer is one-on-one and completely non-biased opinion. So I can work with, to give you some ideas, there are 20,000 mutual funds out there. I can help with, you don't need 20,000, you only need maybe 5 to 10 at the most. I can work with that. There are other service providers like a TPA. You need a custodian and on and on and on. There are 4 to 5 different service providers. Being independent, I'm completely agnostic to any one of them. So you have your payroll providers, like to name a couple is obviously your big guns, is ADP, Paychecks. I can work with them. You have the investment companies. You have Vanguard is probably the most recognized. BlackRock is another one. So these are your investment vehicles. And then you have TPAs, as I mentioned, Ascensus. Ascensus is a company that I have worked with. We have a plan with them which has 1,200 employees. Now, the difference is, again, first, one, that I give a one-on-one. I'm only getting paid on the investments, but I understand the business. I've been in it long enough, and I know where to find the experts and who to bring in depending on your situation.
Great. So coming back to it from the business standpoint, so they're required to offer a retirement vehicle. We'll just put it that way, for their employees if they have. I mean, when we get through with this in a couple of years, from 5 employees on up, every employer must offer this to every employee. With that being said, do you so the company doesn't have to match
Not
deductions,
at all.
and the employee doesn't have to do it if they don't want to, correct?
Absolutely. The employee has a choice. The only obligation is for the employer to enroll the employees in the plan. After that, the employer's obligations are complete. Now, the employee has 2 choices. They can either stay in the plan, they can opt out, and actually they can do their own. You, as an employee, depending on your situation, you may be able to set up an IRA for yourself or a Roth IRA, which is on your own. And you could go to any financial institution to do that. So yes, you're not obligated at that point, and the employee has that choice.
I think some businesses are worried that they have to match, if the employee puts in 5%, they're going to match 5% of their salary or something like that. And the employee doesn't have to put 5%, or the employer. It's up to them if they want to match or not, correct?
Well, when you think about the match, yes, in the CalSavers, absolutely not. So if it is a payroll deduction IRA, the employer does not have to do any kind of match, whether it is CalSavers or any other service provider. There's quite a few organizations out there that offer a payroll deduction IRA. CalSavers is the branded for California, but there's other service providers out there. Now, when it comes to a retirement plan, you as the owner of the business do not have to match or do not have to give any kind of compensation to the employees. Having said that, it would be a nice feature to have in your plan, but it is not mandatory.
It's a great employee benefit if you can help match, if you
Absolutely.
can match something
Absolutely.
to their, it's always nice when you get that
And there
matching.
can be times when, by giving a match to the employee, you as the owner may have a bigger benefit. Now, I can give you, I've been in this business for a long time, so I could give you a couple of examples. I have a liquor store owner that only earns $80,000, and he is putting about $50,000 into the plan, of which almost 49 is going back to him, and the rest is going to the employees. So this is where the plan design comes into play. Depending on the kind of plan you have is what your limitations or what your benefits can be.
Okay. So talking about the company, Let's say I own ABC Manufacturing, and I have over 100 employees because I love bringing business to the Antelope Valley and having a big shop. And I need to get something going. What criteria do I use to find the right investment vehicle or right plan? What's my first step? Where do I go?
The first step would be for you to look at what kind of plan, and that's where plan design comes in. You need to know what kind of plan would be appropriate for you. Now, generally, when you have 100 or more employees, the best thing you could do is probably a standard 401k with an employer match. If the employees participate or not, that's one thing, but you're done. Now, the second part of it is that you need to see who are your service providers. You can go to, again, as I mentioned, the payroll companies or other investment vehicles, and they offer what we call a bundle program, so where everything is done for you by them. Or you can also have your separate vendors or service providers like a third-party administrator, a custodian, the investments can be different, and so on. So that's the first step, is to have what kind of plan should you have. Now, let me expand a little bit on that. If you are a company that has no employees, and I'm going through this scenario right now, it is a husband and wife LLC, but they're making a lot of money. They're going to be able to put, between the husband and the wife, they're going to be able to put almost $500,000 into their retirement plan. Because they have no employees, they have sky's the limit. Now, if you were a company where you had, say, 10 employees, you can still, as the owner, get the lion's portion of that benefit. You do have to give something to the employees. See, every retirement other than an IRA, every retirement plan has a testing requirement at the end of the year. So as long as your plan meets the IRS guidelines and the testing, there are a lot of things you could do as the owner of the business. Once you start going over maybe 25 or 50 employees, then having to match or having to give your employees some money may be a little bit of a challenge, but you could still do it. But once you go over 100, then generally it gets a little bit expensive. Now, if you look at it from a historical perspective, it used to be defined benefit plans where the employer was responsible for everything. And that could cost the employer anywhere between 18 to 20% of an employee's income that they would have to match in the plan, even though the employee would not be eligible till they retire, but the employer had to contribute. So that is no longer. Now you could do maybe 5 to 10% at the most, and you could still benefit.
Okay. And I know a lot of our listeners out there are probably the smaller business owners. I mean, they're probably the 5 to 25 or 5 to 50 employees. So although that doesn't kick in for another year now down the road, you can obviously start today if you wanted to. There's no mandate. You have to wait.
Absolutely.
It's just in another year you have to do it. It's going to be mandated by the state. So you might as well get a head start on it and get your employees enrolled in a plan. Right? I mean, I think that's probably just a prudent thing to do for your employees and give them that option. So for the smaller employee, how do they look at how do they design a plan? How do they go about that?
The first thing they should do is talk to somebody who is in the investment business, look at their credentials, look at their experience. Now, I'm not saying I'm the best, but obviously this is all I do, so I understand this business quite well. I follow all the legislation that has been going on. In the last year, there's been quite a few changes, not just CalSavers. CalSavers is at the state level, but there's something called the Secure Act, which is at the federal level, and there's a lot of changes. So the first thing I would recommend to anybody is please speak with someone you are comfortable with, whoever that person may be, and understand. You can go to the IRS website. They have PDFs that you can follow. And if someone wants to contact me, I can send them that same information. But Those are the first steps I would recommend that you take, because the more you understand what kind of plan is suitable for you, what are the other factors that go into the plan, because there is a cost involved. When you're doing an IRA, generally there's very little cost. It can sometimes companies waive the fees depending on how much money you're putting into an IRA. But if it is anything other than an IRA, like a 401k or profit sharing or something of that nature, then there is cost involved. So you need to know what those costs are. You need to know what the investment vehicles are and what are the costs, whether hidden or not. A lot of times people come and tell you there's no cost to you, the employer. But that's a misnomer, because there is a cost. So who is bearing that? What is that cost, and who is bearing the cost is something you need to know. So this is why it is important to do your planning before you do anything. Don't wait till when CalSavers comes in and says, hey, you have to enroll your employees. You may not have enough time to do that. So this is why the first step is to talk to somebody or educate yourself. The more educated you are, the better off you are, because it is a long-term commitment. It's not something that you set up and then 6 months down the road, you abandon it. You cannot do that. You can, but it gets expensive. So you need to understand, educate yourself, understand what you're getting into, what are the long-term ramifications on it, and go on from there. That's how I would recommend to look into it.
Okay.
You can talk to your payroll providers. Sometimes if you have a company, maybe some of the larger ones, obviously, they generally, the only issue is that when you are starting a plan, it does get a little expensive. But the Secure Act, as I mentioned, that can give you, there are some tax credits. It used to be that you had a tax credit of $500 for a startup plan, which was good for 3 years. The Secure Act has changed that to $5,000.
Nice.
It's a huge number. Now, that doesn't mean you're going to qualify, but it is a tax credit. So it's a dollar-for-dollar credit that you, as the owner of the business, will get for setting up the plan. So these are all the things that you need to look at. And the more you understand, I cannot emphasize enough. You need to understand what you're getting into.
Wow, it's a lot to absorb there. So once that employer, that company goes ahead and sets up the plan, they then go out and reach out to their employees to go ahead and enroll in there, and then the employee gets to choose how much they want to, if they want to, how much to invest into that retirement plan through payroll deductions. Well, maybe I'll ask it this way. If I go to just an IRA, I can kind of pick out my risk that I want in my retirement plan. I can pick out if I want to have high risk stocks, or if I want something that's just very low risk in bonds or something like that. Do you know now I'm sure on your plans you have a whole lot of latitude on that of what the employee can invest in. Does CalSavers, do they have the same type of vehicles, or is it you just go into the CalSavers and you get what they invest in?
No, there is something called QDIA, Qualified Default Investment Alternative. So what that is basically a target date fund. So if you're 20 years old and you're not going to retire till the year 2060, there is a fund which is called the Target Date 2060. And all the underlying investments are done for you by somebody. It's automated. So that is one option you have. Whereas they also have other funds in there. So you can, if you were savvy enough and if you're willing to put the time and effort, there are other investments within that program that you can do. So, and anytime you open an account, whether it's CalSavers or whether you go to any other financial institution, generally they have to allow, whether it's an IRA, even a 401k. In all of my 401ks, the minimum investment options are 20 of them. There are 20 mutual funds, and the target date funds are only counted as one. So there are 19 others other than the target date funds.
Okay, Good to know. I just think a lot of times the employees want to have a little bit of control on what they're investing in. I think that's important to have that option at least out there for them.
Absolutely.
We talked a little bit about the tax credits when you start up the plan. How about ongoing and what are other tax credits that are available to the employer?
There are really, other than the initial startup tax credits, there are really no other credits, but you have to remember that any expense ongoing, the employer has two options. They can either pay it on from the business, so that's an ordinary business expense, or once there are enough assets in the plan, they can pass those expenses on to the employees. They're not obligated to pay those expenses. But there has to be obviously some assets in the plan. And once that happens, they can pass it on. So the benefits, of course, the first 3 years, but then after that, it is an ordinary business expense to the employer.
Okay. I mean, I know we talk about, new legislative changes. What other changes do you see that have just been enacted this year, or what do you see on the horizon too? Where are we going with this?
There's actually something called the Secure Act 2.0, which is right now a bipartisan effort that was just introduced less than a month ago towards the end of October. So it's not obviously law yet, but there's a lot of changes there. One of the changes with the Secure Act that was passed December of 2019 was that now part-time employees are eligible, but there is some sort of testing that is done on a qualified plan. You don't have to include them in that testing, but they are eligible to participate in a 401k or an employer-sponsored retirement plan. And it used to be where you had to have worked minimum 1,000 hours. Now that's no longer. The other changes are that there is something called RMD, required minimum distribution. It used to be 870 and a half. That is now 872 and a half, or 872 actually.
Back up. Explain what that is first.
So when you have a qualified account, like an IRA or 401k or whatever the case may be, once you reach age 70 and a half, you are required to take a minimum distribution out of that account. That used to be till the end of 2019 was 870 and a half. Today it is 872. Now they're talking about even moving that further out to 875. So these are some of the changes. The tax credit that I mentioned. One of the things that you can now do is if you were to adopt a child, you're allowed to withdraw up to $5,000 out of your retirement account. Then there is something called a stretch IRA, if you have heard that. It's basically a beneficiary IRA. Till 2019, the way that worked is you as the beneficiary had your lifespan to withdraw the money. Now it is a 10-year period certain. So in 10 years, you have to withdraw the money. You could do nothing for 9 years, but at the end of year 10, the balance has to be zero because obviously the taxes have to be paid on that. So that's another major change that has gone on in the industry.
Okay. And as far as from the employee standpoint, I mean, maybe a lot of businesses and maybe a lot of employees don't know, why do I need a retirement plan? Why do I need a 401k? Why shouldn't I just go out and buy some high-tech stocks and see what happens?
Well, you could do that. See, the only difference between you saving money on your own and you having a retirement plan, one, you are getting a tax advantage because it can be tax deferred money going into the plan, or it can be a Roth plan. If it is a Roth plan, you pay the taxes now, but the growth is tax exempt. So that can be a huge advantage if you're a young person and you have 10, 20, 30 years before you need that money. Whereas when you go out and buy individual equities or whatever, invest money on your own, there are no tax benefits. So whatever it is, you're going to get more than likely a 1099 at the end of the year, and you will owe that tax, whatever. It may be a small amount, but it'll be there.
Right. You're going to pay taxes on your income. And then when you take that income and invest it, then any gains on that investment, you're going to pay taxes on that.
It is after-tax money that you're putting in.
Right.
Whereas when you're doing it in a retirement and employer-sponsored or any other retirement plan, you're putting the money, it can be either pre-tax or post-tax, which is a Roth contribution. And in a Roth contribution, you're getting the growth is tax exempt. So that's where you can get a big benefit, whereas you're not going to see that in a regular account.
Although the only scary part with a Roth, that you think that you're getting that, Congress can always change that and take that. And
it can happen, but as of right now, there are, it's pretty safe.
Yeah. Well, yeah, I know.
Anything can happen. We know that.
That's true. And that's the scary part is that, you think that, you're not paying your taxes. And the other thing is that hopefully when you retire, you'll be at a little bit lower tax bracket is the other.
That is the whole concept.
That's what the concept is that when you retire, you're in a lower tax bracket.
Yes.
Therefore, the earnings that you have today will be taxed at a lower tax bracket than they would have been, right?
Yes. Now, you're getting a tax break right now, depending on what your brackets are and obviously all that. But when you're putting that money in, it is going in pre-tax, so you're getting a break there. And the idea is that when you withdraw the money, yes, you will have a lower income, and because of which you may be in a lower bracket.
Cool. So kind of wrapping up, and also what just ongoing maintenance. So once I set this up for my employees, new employees come in, I put them on the plan. Some employees are contributing, some aren't. What's my responsibility as a business owner year after year?
The correct answer is depends, and it depends on the type of plan that you have. So if you have an IRA, it's an IRA. There is very little maintenance on your end. As long as your employee is eligible and you're contributing towards, depending on the type of IRA that you have. But once you have a qualified plan, there are a few more requirements that you have to meet. So as you mentioned, when employees come and go, you need to, once they become eligible, you need to give them, all you're doing is giving them the documents that here's an enrollment kit, here's the contact for the advisor, whether it's a person or an 800 number or whatever the case may be, and you're done. Then there are other requirements that there are notices that have to be given generally once a year, which is not a big deal depending on who you work with. They're going to work with you on that. They're going to notify you, but you as the owner need to know that it has to be taken care of. Now, you as the owner do not have to do it. You can delegate someone to do it. But you as the owner have to know that these are some of the requirements. Again, like I said, it's not a big deal. Generally, most of the companies that you work with have everything automated and have a schedule, so they will notify you. You just have to implement it.
Cool. Wonderful. Hey, I really appreciate you coming in today. For people that want to contact you and want to sit down and look at plan designs and see what's out there so they can comply with the law, how do they get a hold of you?
They can go to my website, which is pnrfinancial.com. They can give me a call. I'm at 661-524-9052. Again, that's 661-524-9052. Or they can send me an email, which is my first name at pnrfinancial.com, which is Pankaj at pnrfinancial.com.
Great.
And I'm also a member of the chamber, so
go to the Antelope Valley
Miss
Chambers
Anna
of Commerce.
And Miss Sharon are always willing to help.
Absolutely.
Now, one of the things I do want to mention to you, which I should have covered, is we talked about some of the legislation. There is something called an association retirement plan. Now, as the chamber, we can offer it to the members, and there are some things that what the biggest advantage that it can have is it can take off the liability off one employer and make it onto the board or to the chamber, and they could be one lead employer. And the benefit to the other businesses would be the cost sharing.
Right.
So these are some things that it's a little bit more involved for, not really, this is not the best way to describe, but at least it's out there, and that is something that is coming down the pipe.
Good. We'll the board take a look at that and see what we can do. So, Pankaj, I appreciate you coming in today, our local expert on all things retirement plans. PNR is the name of the company. Hope you enjoyed our podcast today, and I look forward to having another guest on here really soon. Again, my name is Mark Hemstreet. I'm the CEO for the Antelope Valley Chambers of Commerce, and this is Chamber Talk. Thank you.